The following is a presentation of TFNN. It is now time for Trade What You See with your host, Larry Pesavento. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Larry Pesavento.
Looking good, Billy Ray. Feeling good, Lewis. Welcome to Friday. This is a Friday in a down week. It's going to take a lot to get the market to close up strong today, in my opinion. The key will be what will happen on Monday, because these folks do their work over the weekend, these hedge fund and mutual fund folks. And I believe some of the moving averages have turned down, so that might have an effect on even more selling possibly. One thing I feel pretty confident about is we are going lower, and we're going to go a lot lower, probably a lot more than some think. 1 second, please. Excuse me. Okay, the first chart that I've posted in is from my my good buddy and trading partner, Jim Bartolioni. And if you'll notice here, it's the chart showing the swing lows since March of 2009. And it's hard to believe, but we have never taken out a swing low until this week. In other words, every low has been higher than the previous low. I mean, that's an amazing statistic, folks. So, you know, keep that in your mind to, you know, what could possibly be happening. Now, the next one I wanted to cover, I'm going to go these in turn so that I can, you know, show you what I'm watching anyway, whatever that's worth. And hold on a second, I've got to get it ready. There we go. I did something wrong here. Hold on. There we are. There we go. I have to get it so that it'll fit the screen. This is the breadth statistics, and as you can see, you know, the advanced declines fell out of bed again after a little bit of a rally. It's just been showing you all along for the past 3 or 4 weeks, you know, how bearish the market really has been. And there's just not a lot of stock that people want to buy, and that doesn't mean you're not going to see some short covering, but you know, you're still going to be looking at a market that's you know, under a great deal of pressure. Now, the most important chart that I can find of any chart that I look at will be the next one that I'm going to show you, which is going to be the New York Stock Exchange Index chart. If you'll give me a second here, I want to bring it up because it did something really amazing yesterday. It gapped below all of the lows since July the 6th and 7th. I mean, we gapped down on those and we closed badly. That's not a good sign. What that means is that line that we gapped down from, that will now become resistance when we do start to get a rally. But that's an incredibly bearish scenario, folks. That means that everybody that's bought stocks on the NYSE index since July is now underwater. And some of these stocks are underwater big time, you know, Twitter and a few of the others. But this is not a good situation. We broke a swing low. We've broken down here. We've gapped down. Even our measly old VIX index has finally perked its head up, not by much, but it did perk its head up by a little bit. And I wanted to bring this to your attention to let you see what that looks like. And then I have a couple other odds and ends that I want to cover. And then we got to get to something that I think is going to be spot on here if I've did the work correctly, and that's in the gold and the silver. So let's take a look here at the VIX index, and you can see that you know, we've had a pretty good rally. We've gone from 11 and change up to 20 or 19, almost 19 and 20. But that's nothing, folks. I mean, this thing's going to go to 50 or 60, I believe, or probably even higher, probably above the old highs at 99 would be my guess, because the situation is so different this time because of quantitative easing. That's going to be the problem. That's my opinion, of course, and I might be wrong. I'm wrong a lot. I was certainly wrong about that low potential last week in crude oil. We did go down and make a new low. We haven't collapsed yet, but boy, we're really close to it. So You have to wait on crude oil. There's not really much else to do. So, but the VIX index is showing signs that we're getting ready for some fear coming in. This is the first time we've had any fear coming in the market, but there's still not a whole lot. It's just really very, very little. That's the bottom line of what you're looking at. Now, I want to show you a chart. This is from my friend in Athens, Greece, Kostas Fionis, and he's got a really great chart here that I'd like to share with you. This is the weekly chart of the 10-year note. And as you can see here, we have a series of lower highs all during 2015. We just completed a Gartley pattern yesterday, and that tells us that interest rates should be getting ready to go back up again, and notes would be dropping. So that pattern is such. Now, there's been a divergence between the bonds and the notes. The notes have gone up to exactly the 61% retracement, but they couldn't take out the previous week's high. The bonds, which are more volatile, were able to take it out by about 23 pips. But the German Bund, the 30-year bond for Germany, went exactly to the 61% retracement and didn't go a tick higher, at least not yet. And it's still early, maybe it will because they're still trading over there. But this is telling you that they got to be really careful in here. And the reason why is they build these cases for a flight to quality. And my idea of a flight to quality is cash. Frankly, that's what I think a flight to quality is. But, this could be a situation where you're looking for a flight to quality and you're using gasoline to put out a fire. So I'm not sure. I'd just be really careful in here, because if we get a reversal in these bonds and notes or next week, then that'll tell us that, that's not the place to be. And remember, this is all chart stuff, folks. This is nothing to do with the fundamentals. I don't understand the fundamentals. I never have. I've never tried to very much, but that's just neither here nor there. Now, the next one I wanted to show you, because it was important this week, because we had a big report that came out that showed that we had the best housing numbers that we've had in 8 years. And as you can see, this is the Dow Jones Home Builders ETF, and we went up there and then we gapped down and retraced all of the early mornings, or all but below. Everybody that bought it into that report is now underwater in it. So that's a very negative pattern. Also, it's a very characteristic of a topping pattern. So that's another indicator that this could be something a lot more significant that we're watching. Now, I'd like to share a chart with you from my friend John Murphy from Technical Trading, and I'll bring this one up to show you. This is the World Index. It's a weekly chart, and it goes back and it shows all of the weekly stock markets, and you'll be able to see. This is traded at the FTSE, of course, but you'll see that we've broken down below the July lows, much like we did in the New York Stock Exchange Index. This chart looks very similar to the New York Stock Exchange Index because it also topped on May 19th, which was the new moon, and Mercury going retrograde, and now we've broken down. There's a couple other things that I think we need to pay attention to. Is one is the Bradley, and the Bradley model is, oh my gosh, it's so far from being perfect, but the one thing that it does do is when it's right, it's pretty right. And this thing is pointing down into September, right around the equinox, around the 21st. That does not mean that we're going to have some, really serious rallies. We are, but the question is that the overall trend of this thing is down. A perfect example of how bad the trend is when we had the Fed talking on Wednesday. I think it was Wednesday. Yeah, it was Wednesday, and the market had a huge rally. We were down 200 and some points, and the Dow got back to unchanged, and then it was closed down 160. I mean, that was screaming to you that, wow, something's not right here. And so this appears that we are in a midst of a downtrend. Now, the way that this will set up for a move, in my opinion, is we're going to have this break. It might be might stop anytime. It could stop today, it could stop tomorrow, could stop Monday or Tuesday, Wednesday. I don't know what day it's going to stop, but we'll hit that and then we'll bounce. And what you want to do, and we'll follow this each day here at TFNN on our show, is we want to watch for that 2 or 3 day bounce, because what it'll do, invariably it does the things that you don't expect it to do, except when you're looking at it technically, is you'll watch for that 382 retracement of the whole move from the high to the intermediate low that we're going to make here in the next few days, and then you'll watch that 382 rally. And if it only takes 2 or 3 days to make a 382 rally and then reverses, folks, that's the real easy money. In Elliott wave terms, that would be a wave 3, and that's supposedly where the easy money is. And I have a tendency to agree with that, but I don't do Elliott wave counting. All I know is that when you get a bounce that only stops at a 382 retracement, you certainly want to pay attention to that, because it's extremely important. There's been a lot of talk, and John Logan mentioned it in his show about the death cross, and we've talked about this several times here in the past weeks or so, and it's nothing more than these moving averages turning lower. And we have certainly done that in everything now, with the exception of the NASDAQ. I don't believe the NASDAQ has crossed under its 200-day moving average. I didn't check it, but I should have. But I was remiss at that because I'm not involved in it, so I didn't really watch it very much. So we'll see if that's going to be the case, if it's going to do that. Now, one other chart that I wanted to share, and this is from my good friend Ricky the Rocket LaRusso. He ran Shearson Lehman's technical department for many, many years, and he has sent me a chart showing me the relationship between the Brazilian real and the commodities. And you'll see that Brazil is so really tied, to the CRB index. And as you can see, the CRB index has continued to go down, and we're going to have a bottom somewhere down in this area, but we'll have to just give it just a tiny bit more time, is my guess. That's the real reason that we want to look at this. Now, I'm still looking for a potential bottom in the crude oil market, and the main reason for that is that we've been down 8 weeks. Now, on the 7th week, which was last week, I thought we were going to do it, but we didn't do it. So I'm still looking for a pattern in here. I haven't seen anything at all to tell us to get long the crude oil market. But I am watching, and the whole world is short the crude, folks, just like the whole world was short the gold $90 ago, and that's what you don't want to do. So you want to keep that in mind. We're going to have a little break here relatively shortly. When we get back, we're going to talk about gold and silver, because I think we've reached an areas where you've got to be a little careful on the long side. We'll be right back. 877-927-6648.
Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date, active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters. TFNN is excited to offer a brand new piece of market scanning software unlike anything the industry has ever seen. John Logan and his team have spent years developing their market profile tools to finally be able to release the TAS Profile Scanner Plus. And right now, you can get a 2-week trial absolutely free just by visiting TFNN.com and providing us your name and email address. The TAS Profile Scanner Plus is the premier market profile-based scanner in the industry. Powered by the acclaimed TAS proprietary algorithms, this feature-rich scanner is a standalone desktop software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Within 3 minutes of signing up, you can have the software downloaded and running on your computer with a complete roadmap of market indicators and inflection points to trade off using the TAS Profile Scanner Plus. Sign up today and try this amazing piece of software by visiting TFNN.com.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN, and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
Tiger TV is an exciting way to experience TFNN programming. See high-definition video, giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. Larry takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Okay, we're back, folks, and I'd like to talk about the gold market for a minute here. I certainly, let me put this chart in here. I thought that I did, but my goodness, I didn't. Here we go. This is the gold over the past, several months back from August. Now, we've had this huge rally that started at 1065. We got up to 1165. We rallied $100 an ounce. If you remember, I thought the rally would be somewhere between $100 and $150 an ounce. And now we have a situation where we have, if you'll notice the red boxes on this chart, the first red box, which is the one in May, that was a $100 rally, and what we did now is a $100 rally. We're looking at the potential shooting star pattern here in the gold, because if gold closes below 1150, that would set up a shooting star pattern, and this old cowboy is going to be short gold if it does that, because I'll know my risk will be above today's high, and it's in a very overbought situation now because we basically have been straight up since July to the 27th. So we've rallied, quite a bit. We've rallied, let me see, 27. We rallied 3 weeks, without too much, selling in between. And then if we take a look at the, oh dear, I thought I had this done. Shucks. Give me 1 second. I wanted to show you the larger ABCD here. Well, it's a blow up of the daily, but you'll be able to see it because this is one of the one of the price objectives that we were looking at yesterday. I've lost the chart that I was looking at, but this is a 4-hour chart that shows that we did have a 5-day correction between the 13th and the 18th. It stopped exactly at the 382 level, which was 1107, and then that target took us up to 1165, and the high today so far has been 1167.90, so that's certainly come into that realm there. But you want to watch how it closes today, because it closes below 1150. That's going to tell us that this shooting star pattern, this pattern is correct, and we'll get a minimum of a $30 to $50 correction just making a 382 correction. So it has a high risk reward possibility on this if you're watching something that you're interested in that. Okay, now what we want to do next now is to take a look here at this this gold market. Let's try English, Larry. We're going to try the stock market. Wow. Whew. I think I better call the end of days nursing home and get my ticket punched. Okay, we're going to take a look at silver, SILVER, silver. If you'll notice that the blue line that you see on this chart, I've got to make it a little clear. Hold on a second. There's what I want to show. Let me move it up just a little bit. There's better. More better. Okay. Now, we'll take a look at silver, and you'll take a look at the gold. You'll notice that silver, all it did was take out the highs at the 1560 level. 1558 was the old high before we broke 70 cents last week. Then we went up and took that high out, and now it's starting to close lower. You'll notice the relationship here. The gold has been far, far stronger, which it's been for quite some time. Now, if we go down to the 250 minute chart that we've looked at several times here at TFNN over the past weeks and stuff, you'll notice that all we did was make a 61% retracement of the high that we made way back in June. So that's a very, 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 very poor rally. I mean, it really is. And we've only made, believe it or not, that high that we made last night at 1572 and change, the 382 retracement of the whole move down from $17.80 per ounce came in at 1569. So, boy, that's spot on to 382. That's why we could easily see the market back off. And the fact that it's much weaker than gold and copper is still very, very weak. So all of that is telling us that we're in an area where we've seen, something happening, that could be, very, very dramatic. So that's what we're watching in the gold and silver. The key today will be if gold can close below that 1150 level, that would be the one that I would be watching very, very closely. Now, we've had a request to take a look at the Australian dollar, and I wanted to bring that out because we have a situation where we're watching these commodities for a potential spot where they could come down from. And our good friend Scott, Dr. Scott in Florida, asked us to take a look at it, so we're going to do that. And we're going to talk about that when we get back. 877-927-6648.
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization memorization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's nadex.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
Today, it's hard to tell if the economy is coming or going. Regardless, I want my money going in the direction I choose. If that's your stance as well, then you want to know how Everbank can help keep your money thriving just the way you want. Is growing your money a priority? Everbank is committed to a yield pledge promise to pay high yields on your checking, money market, and CD balances. Looking to diversify? Everbank ingeniously developed accessible ways to spread your money around the world into foreign currencies and even non-FDIC insured metals. And when it comes to your wealth, they bring a highly experienced and global perspective to help you manage it. Everbank's financial philosophy flies in the face of the status quo. They believe your money's performance should not be determined by today's economic circumstances, but by the drive to rise above them and create opportunities that favor your objectives. If that excites you like it does me, visit everbank.com/TFNN to find out what they can do for you. Again, that's everbank.com/TFNN. Visit them today. Everbank is a member FDIC and equal housing lender.
TFNN has just announced a brand new morning lineup that is geared specifically for traders in this volatile traders market. Every morning at 8 a.m., John Logan starts things off with his daily program, The Global Market Pulse. At 9 a.m., Larry Pesavento trades the market during the market open Monday through Friday on Trade What You See. At 10 a.m., Tom O'Brien hosts the Money Masters for the hour, and Basil Chapman hosts his Tiger Technicians Hour at 11 a.m. From 8 a.m. till noon every market day, these traders are with you as they provide up-to-the-second market information so that you can make the most educated and profitable trades possible. The new TFNN morning lineup is happening right now. Tune in to see for yourself what kind of actionable trading discussion they have each morning, Monday through Friday, starting at 8 a.m., live only on Tiger TV at TFNN.com.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Okay, we're back, folks, and I want to post a chart here for the Australian dollar, and I had it, and I don't know what happened to it. And there it is. Just give me a second here. And I'm really surprised that the Treasury bonds are not much higher than they are because of the fact that there should be a flight to quality. And like I mentioned, I think that's like putting gasoline, on the fire. But we'll have to let the market tell us, what's going to happen. All right, this Australian dollar now. This is the daily. And as you can see, we're completing a whole bunch of ABCD patterns here. But what's interesting about this chart, and Dr. Scott brought this, wow. Hold on a second. Let me see if I can speak English. Let's just do a quick wow. Maybe I'm trying to talk too fast. Hold on a second here. I just want to bring this in. There is a really nice head and shoulders pattern here that deserves our attention because everything is getting whacked, and this is starting to hold, which is a good a good sign. And we've had higher bottoms now since the 12th, which is also a good sign. That was a 61% retracement. We've held it for 3 days in a row now. So as long as we don't go below 72.90 in the Australian dollar, this certainly has a chance for an upside bias. Now, this on the long-term charts on the Australian dollar, we are really close to something that could be very, very important, and that is this long-term ABCD pattern is almost complete. I mean, it's within a heartbeat, and maybe that's close enough because it's within about 40 or 50 pips. But as you can see, on the way up, the ABCD pattern picked the high in 2011, and now what we do is we have the mirror image of that happening right now in 2015. So somewhere down in here, we're going to see a pretty good bounce in these commodities. Whether it's going to be related to the stock market or not, I'm not sure, but we'll have to let history tell us. But right now, if you want to look at a currency to buy, this would be the one that I think has some really good potential from the long side, because it is extremely oversold still, but is starting to show signs of holding. But remember, some of these, we thought this was going to happen in crude oil last week, and I was certainly wrong on that one. But we'll let history tell us what's going to happen with it. But this Australian dollar still looks like it's making some type of a pretty good pattern in here to take a look at it from the long side. Okay, now the next pattern that I wanted to take a look at, of course, is I want to share with you the Treasury bonds. We're going to go over to the September bonds and take a look at those, and we'll just get those up on put that up on a 250-minute chart. I wanted to show you the difference. Shucks, it's not updated. That's the problem. All right, let me get the 240-day chart in, and I can see that one a lot better. Okay, there's where we are. Let's move it over here. Whereas the T-notes have made the 61% retracement, the Treasury bonds have actually gone above it. They stayed below it most of the time yesterday, or the day before yesterday, until the proverbial shies hit the fan, and then everybody started to run to buy notes and bonds, and they're trained to do that. That's the ultimate safety thing, and I don't think that's the right thing to do this time. In 1987, when we had this happen, that was the thing to do, because you could literally, bonds were, they still were yielding about 7 or 8% at that time, and with the stock market down 500 points that day, the Treasury bonds were only down a half a point. I remember it so vividly because I was short stocks and long bonds, and I was so afraid that I was not going to get my money out of my account that I literally took off the bond position, and it was a wrong thing to do. It was, you stop and think, well, bonds only be down a half a point with the end of the world happening, and believe me, that was really scary stuff, folks. That's the scaredest I have ever been in all these years in the business. I mean, that was just flat out white knuckle time. But as soon as the bonds started to rally, at the end of the day, they ended up being up about a half a point, and they went 11 days without a retracement, and they ran 15 points, 15 handles. I mean, just straight up with short covering. I mean, it was just unbelievable move, and that would have been a better trade probably than the short stocks that I had, because there was greater liquidity in the bonds than there was in the stock market. So remember, try to trade each one of them separately. That's the bottom line of what you want to do. I don't see any better way to do it than that. That's really about all you can do, in my opinion. So just keep that in mind, that there's something very amiss here. Now, if we look at this going across the pond that we did yesterday, because all this is, international stuff, you have to look at this too, and that is the German Bund, which is the fourth largest, what do you call it? Hello, operator. The fourth largest, oh dear, just a second here. Fourth largest country in the world. And so we want to follow their economy. If we look at their 30-year bond, this is the German Bund. I don't know why they don't call it Bund. I guess it's the word for German bond must be Bund. But anyway, you'll notice the high we made back in April. The high today was exactly a 61% retracement. It's already dropped well over $1,000 from that level. It went 1 pip higher than the 61% retracement. The high was at 155.88 and 155.93, and we're now trading 155.49. Now this trades in euros, folks, so it's a bigger handle, and it's a larger size contract than what we deal with the 30-year bond, but it's very, very heavily traded. But if you look at this chart from June to July, and I pointed this out yesterday, the June to July, and then where we are from July to August, that was a very beautiful symmetrical ABCD pattern coming in at the 618, which makes it a perfect definition of a Gartley pattern. Now, if we get above today's high, this pattern will most certainly fail, and something is wrong. So just keep that in mind. That's what we're watching when we're looking at some of these things, because these patterns, you know, they fail all the time, and sometimes they work, sometimes they don't. But when they work beautifully, and when they don't, that's telling you something too, because it's basically telling you that you don't want to stand in front of it. For example, we've had a request to review that trade we talked about in wheat yesterday. And that was, we bought that down at the 495 level, and we had a Gartley come up around the 511. The high was 513, and now we've dropped 9 cents. Again, we're moving back down to probably the $5 support level here in this December wheat. And all this was a Gartley pattern with a downtrend. We had a downtrend, and with the the ABCD. So that's all you can ask for. You don't have to be a rocket scientist from MIT to figure some of this stuff out. You do it with a handheld calculator and a pencil. That's really all you need. So that's the key. Okay, now we're going to dance with the devil here, folks. Put on your dancing shoes, because we are going to dance with the devil now for a few minutes. Give me a second, and I'm going to show you what I think is happening, and I'm probably as wrong as a guy that's using a divining rod trying to find water. Oops, I did that wrong. Give me a second. I wanted to do the daily chart. Oh, there we are. Hold on just a second here. Yeah, this is the euro. This will do a couple things here. Let me move I've got to label it so you're able to see where we are. But I want to give me a second here to put the numbers in, and then I've got to change, because that didn't happen. Okay. Thanks for bearing with me. Give me a second to draw this in, and then we'll be able to take a look at it. Okay, this is the euro on a daily basis. Okay, and give me a second here. Put this in. Bada bing, bada boom. Okay, this is the euro over the past 5 weeks. This morning, just a little while ago, we went up to right near that 786 retracement. Whether that's going to be the high or not, we're in the third day of a run. We're completing an ABCD pattern. We're completing a 1.5 extension of the BC leg, and we're right at the 786 leg. We're still in a downtrend, of course, but we've had some higher bottoms since April, so this could easily fail. Any move above 113.30 or 40 would certainly tell us that this whole thing about the U.S. dollar strengthening is bogus. But right now we are looking at something that tells us that there's a potential here that this might be an area where it could run into a little bit of trouble as far as going to go lower that we think it's going to lower. Remember, now let's try it again. Let's look at the long term, because the long term really holds the key here, in our opinion. And you'll notice that we've had this huge rally here. We'll put the weekly up, and you'll be able to see it. So we're at such a critical level here that we're able to see this. Now something went off on my limit minder. Oh, I know what it was. The New York Stock Exchange index just broke a real key level. 1 second, please, and I'll bring this up. I have it put in here for a reason. So let's just take a look at it, and we'll see what we have. Going on here. Give me a second. And oh yeah, there it is. Wow, this is really a negative. Well, this is going to be real interesting here, folks, because we just made a well, I'm going to have to. They just posted their first trade, so you can't really read too much into it. But I'm going to bring out the pattern here in the New York Stock Exchange Index, and that little red dot that you see inside the red box, that's the open. And if you'll see the ABCD pattern coming in, that's the ABCD pattern coming in at this time. That's why my alert went off to tell me that that pattern was now getting there. The problem is that you've gapped down, and this thing could just accelerate rapidly. We've already accelerated rapidly in the NASDAQ. We haven't done it yet in the S&P, but that's still relatively early to see if it's going to do that. Now, while all this is going on, what I'm watching is, because the whole world is watching what's going on, is I'm watching what's happening with the euro, and I'm watching what's happening with the treasury bonds and treasury notes, because that's where the money's moving. I mean, the stock market is virtually insignificant compares what happens in that bond market. And if we look at that junk bond market, what's happened to it? It's in a free fall. I mean, it literally is, it's just gapping down every day. And so, I don't see how the Fed is going to come in here and raise rates in an environment like this, because this is a spot where usually they would come in and, do something to prop up the market. But this is not happening as of yet. But this is, like John Logan said, this is really insignificant. This is not much at all. It's basically not very much. And, all you can do is say, yep, that's true. It's not very much, but, that's what's going on. So you got to respect it. But you stop and think, you got bonds basically unchanged on the day, with the Dow down, I don't know how much it is now, down almost 200 points. So it's, down 180. I mean, that's not a big deal. So I'm keeping an eye on this. Now, we did make a lower low in the S&P by a little bit. It hasn't, collapsed as of yet. So, we're going to get some big rallies. That's all I know. But long term, going over a period of the next couple of months, especially into September 21st, I believe we're going to be coming down, and the market is set up to have a crash. It really is, but it's not going to crash from here, I don't believe. I think you're going to see a bottom come here in the next day or two, and then you'll see the rally. And that's the rally. There's the key. That's the one you want to watch. That's where you get paid for your technical ability. Is if you see this 2 to 3 day rally and you time it right, it's going to be a really smooth ride, down into the final wave 3 of this thing, and that would be the one that would be very interesting to unfold. Hopefully we'll get lucky. Well, lucky is preparation. Luck is where preparation meets opportunity, and the opportunity is coming, and I certainly want to be prepared for it. So we want to watch it very closely here. So we got to take a little break here. We'll be right back and wrap it up.
Biotech is booming, but for how long? Whether you think the biotech bull has room to run or has run its course, trade LABU or LABD. Directions Daily S&P Biotech 3 times bull and bear ETFs. Visit directioninvestments.com/biotech today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction shares at 866-476-7523. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
Hi, I'm Steve Rhodes, host of the Trader's Edge, heard daily at TFNN.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of TFNN.com.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to the Gold Report, an $85 value, visit the front page of TFNN.com today.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
The Bull Bear Binary Option Hour, sponsored by Nadex. Up next on TFNN.
Okay, we're back, folks, and I posted the chart of the cash S&P index. As you can see, the low that we made back in July was a 1.5 expansion of the CD leg, of the AB leg. You multiply time 1.5. That took you to where you are. Now, today's low so far, we gapped down quite a bit, which we got a big gap here now to potentially fill, but that'll be resistance. But we did stop right at the 1.27 expansion of the first AB leg. As you can see, we have a Gartley pattern forming, and the low today was spot on right at the 786, but we've really got to weaken up here to get below that in order to get the market a lot lower. But gapping down, you know, we certainly could, but the other question is we could hold right here also. This is a real key spot. So just watch it. If we close below there, we're going to go, boys and girls. I know I'm mumbling around here, but bottom line, we're going lower. There's no question about it. We gapped down below the July lows yesterday in the New York Stock Exchange Index. That's incredibly bearish. We have the Bradley model pointing lower. We got the advanced decline line. We got all the sectors are going. We got the commodities coming unglued. This market is not going to go just lower. It's going to go a lot lower. So, this might get you a chance to, get out of some of the stuff that you have to get out of. But unless I'm wrong, boy, this certainly looks very, very bad. I mean, it looked bad on March the 19th, but it was way up there because we were having massive distribution. People were selling stocks like crazy up there. We had more new lows than new highs during that time. And, the advancing volume hardly ever surpassed the declining volume except on these real wild rally days. So we are going to go lower. The question is whether we're going to go lower today or whether we're going to be sideways. Now, what I would like to see from a personal standpoint, I would like to see the market hold and actually maybe close up on the day a little bit, because that would be the first day of the rally, and that would give us a chance to be watching, what we're looking at from a shorter term. So that's it, boys and girls. Live every day in an attitude of gratitude and do something nice for someone who has a lot less than you today.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.